A mortgage rate lock sounds simple. You find a rate. You lock it, and you feel protected. But rate locks can create problems when buyers do not understand the timing. A mortgage rate lock is an agreement that protects a quoted interest rate for a set period of time. Common lock periods might be 30, 45, or 60 days. If rates rise during that period, the lock can protect the buyer from the higher rate. That is the main benefit. But the lock is not magic. It has rules. It has an expiration date, and sometimes it has costs. The first mistake buyers make is locking without understanding the closing timeline. If the lock period is 30 days but the closing takes 45 days, the buyer may need a lock extension. That extension can cost money, and if the delay is not handled properly, the buyer could lose the locked rate. This is why the lock period should match the real closing schedule. Not the best case schedule, the real schedule. Appraisals can take time. Underwriting can ask for more documents, title issues can appear. Seller delays can happen. Condo approvals can slow things down. Any delay can push the closing past the lock expiration. The second mistake is focusing only on whether rates might rise. Buyers also worry that rates might fall after they lock. That can happen. If rates fall after locking, the buyer may feel trapped with a higher rate. Some lenders offer a float-down option. A float-down can allow the borrower to take advantage of a lower rate if rates drop enough before closing. But float-down options often have rules. They may cost extra. They may only apply if rates fall by a certain amount. They may only be available once. They may not apply to every loan. So buyers should ask about it before assuming it exists. The third mistake is comparing locked rates without comparing the full loan estimate. A lender may offer a lower locked rate but charge higher points or fees. Another lender may offer a slightly higher rate but lower costs. The rate lock does not replace the loan estimate. The loan estimate is still the document that shows the real deal.
Rate, points, lender fees, estimated cash to close, and monthly payment all matter. Now, let us use a simple example. A buyer is under contract on a home. The loan amount is $350,000. They are quoted 6.5% and decide to lock for 45 days. 2 weeks later, market rates rise to 6.8%. In that case, the lock helped. It protected the buyer from a higher payment. But imagine the appraisal is delayed. Underwriting asks for more documents and closing is pushed beyond 45 days. Now the buyer may need an extension. If that extension costs money, the protected rate is still useful, but it is no longer free. Now imagine the opposite. The buyer locks at 6.5%.
Then rates fall to 6.25% before closing. If there is no float-down option, the buyer may not automatically get the lower rate. That can feel frustrating. But the purpose of a lock is protection, not perfect timing. It protects against rates moving against you. It does not guarantee you get every better rate that appears later. This is why trying to time the perfect lock can become stressful. Rates move daily, sometimes intraday. Economic data, bond yields, inflation reports, Fed expectations, and investor demand can all move pricing. Most buyers will not perfectly guess the best day. The better strategy is to understand your risk. If your payment is already near the top of your budget, locking can protect you from being priced out before closing. If you have more flexibility and the closing is far away, you may compare options carefully with your lender. But do not treat the rate lock like a casino bet. Treat it like risk management. Before locking, ask your lender these questions. How long is the lock period? What does it cost? What happens if closing is delayed? How much does an extension cost? Is there a float-down option? What has to happen for the float-down to apply? Are points included in this rate? And can I see the full loan estimate? Those questions matter more than trying to guess tomorrow's rate. A mortgage rate lock can protect you, but only if the lock matches the closing timeline and the full loan terms make sense. Locking too short can create extension costs. Locking without reading the loan estimate can hide fees. And assuming you can float down later can lead to disappointment. The rate lock is a tool, not a guarantee. Use it to control risk before closing, not to pretend the market stopped moving. There is also a practical reason buyers need to understand rate locks. The final weeks before closing are already stressful. The buyer is sending documents. The lender is underwriting. The appraisal may still need review. The title company is preparing paperwork. The seller may be fixing issues. Insurance must be finalized. Cash to close must be confirmed. In the middle of all that, mortgage rates can still move. A rate lock reduces one source of uncertainty, but only if the buyer understands the rules before the clock starts. One mistake is assuming every lock works the same way. They do not. Different lenders may offer different lock periods, extension fees, float-down rules, and pricing adjustments. Some locks may cost more upfront. Some longer locks may come with slightly worse pricing. Some shorter locks may look cheaper but create risk if closing is delayed. That is why the cheapest-looking lock may not be the safest lock. The lock should match the transaction. If the closing is expected in 30 days but there are obvious risks, a 45-day lock may be safer. If the property has appraisal issues, condo approval, title concerns, or seller repairs, the buyer should ask whether the lock period is realistic. The rate lock is not just a number. It is a deadline, and deadlines matter in real estate. Another issue is responsibility for delays. If the lender causes a delay, the lender may handle the extension differently than if the borrower caused the delay. If the borrower fails to send documents on time, the extension cost may fall on them. If the seller delays closing, the buyer may still need to deal with the lock expiration, so buyers should ask, who pays if the lock expires? What counts as my fault? What counts as lender delay? What happens if the seller delays? Those are uncomfortable questions, but they are much easier to ask before there is a problem. Rate locks also matter for affordability. If the buyer barely qualifies at the locked payment, a rate increase before closing could threaten the approval. In that case, locking is not just about saving money, it is about protecting the ability to close. For a buyer with more room in the budget, the decision may be less urgent, but for a buyer near the limit, a lock can be very important. The real takeaway is simple. Do not treat the mortgage rate lock as a casual checkbox. Treat it as part of the closing strategy. Know the lock length, know the expiration date, know the extension cost, know whether float-down exists, know whether points are included, and keep the closing timeline realistic. A rate lock cannot make the market predictable, but it can make your mortgage offer more predictable if you use it correctly. Educational content only. This is not financial, mortgage, tax, or legal advice. Always compare real loan estimates from licensed lenders before making a mortgage decision.